Okay, so we move to Chapter 2, Income Tax Computations, Part 1. Now, here's where things start to get more interesting. And when I say interesting, I mean we're going to start dealing with numerical issues, calculations, rules, and little tricks that the examiner will play in this area of the syllabus. Note, income tax around about half. We have to be familiar with income tax computations, and we need to be able to lay one out. I produce one, particularly Section C, fairly quickly. Don't have to be perfect, but we need to know the main elements. So let's kick off. Let's look at the first area here, which is basically just, an introduction. What are we talking about when we say an income tax computation? Well, we know from Chapter 1 that income tax is levied on individuals. Now, it's levied by reference to their taxable income for the tax year. Remember, the tax year for individuals, 6th of April to the 5th of April, okay? Now, what do we mean by taxable income? Well, we mean the total income less certain deductible amounts, okay? More of that later. By total income, what are we talking about? Typical UK taxpayer, what do they have? Trading income, maybe employment income, property income, etc., etc. Now, in terms of the computation, I'm going to make this a little bit bigger, so that we can actually see it properly. I will show you the whole thing, but let's start at the top and let's focus in on this particular section, which is basically the area where we sort of populate, as it were, and to include all income. Now, I'm going to slow down a little bit because I want you from this video to get a good feel for this computation. First things first, columns at the top. What's happening here? Well, 4 main columns, non-savings, savings, dividend income, and a total. Now, we know broadly speaking from Chapter 1 that non-savings income is just that. You'll see it's basically income that's not relevant to savings. In other words, sort of earned income in one sense. For example, trading income or profits of an unincorporated business, employment income, pension income, property income. So this is where we have to place non-savings income. It must work in this order. Savings income, as you would imagine, interest. So I have a bank account, I earn some interest. Let's put it here. Dividend income, we know what a dividend is. Basically, I hold shares in a company, maybe a private company, maybe a PLC, a listed company. This is where I put it in. So this is, if you will, part 1 of the income tax computation. All that I'm doing is just populating. And indeed, we'll note from each of these areas, and indeed, in effect, these areas, that the rules relating to different forms of income need to be learned. Income from dividends or from non-saving is treated differently, taxed differently, etc., etc. So this is the key, I guess, in tax, is understanding not just the layout of the pro forma computation, but also the rules concerning each area of income. So what does this give us then if I have a scenario or a question in the exam and I populate? In other words, I include, okay, well, this income goes there, this is employment, or this is dividends. It gives me total income. I get total income across the board and casted here. Okay? Where do we go from there? Remember, that's part 1, as it were. Well, we sort of go down into this area of what you might call reliefs, or indeed deductions. Okay? This is where, if you will, sort of part 2, where we deduct anything that's relevant. Now, for the moment, for reliefs, just note that these are areas that, good news really, these are areas that reduce our total income before we get further down the income tax computation and start applying tax rates. So I like reliefs, So for example, qualifying loan interest, or perhaps over and above that, maybe loss relief. This area of reliefs, note the order, non-savings first, reduces total income to bring us to this line, net income. What's happening here? We'll see something referred to as the personal allowance. Now, this is important. One of his little tricks, the TX examiner, is in this area. I'll explain a little bit more later. But what do we mean by personal allowance? Basically, an amount that's in effect free pay. So we have a personal allowance that really is deducted from net income that we don't pay tax on. That's it. Yeah, we are cleared. We do not pay tax on that amount. Now, in terms of the trick, yeah, or the sort of caveat, I will explain that, but what it results in for high earners is a reduction of this personal allowance, possibly down to zero if you have very, very high income. Okay? Make a note, make a mental note of that, and we'll come to it later. Where do we get to then? Well, we're bingo, we're done. Taxable income. So we populated, yeah, across the three columns, yeah. We then came to this sort of deductions, relief, strokes, PA area. We got to taxable income, yeah. And here we are now, yeah, at the area where we start applying the appropriate rates. Tax thereon at appropriate rates. Now, the key point to note here, yeah, is that these different forms of income are taxed at different rates, generally speaking. And indeed, all of the rates are shown in your tax tables, which you will have in the exam. So don't be overawed, don't be put off and think, oh God, the first income tax comp, this looks complicated. It's not overly so. A couple of areas that can catch you out, but you know, to get down to the bottom, it's not overly complex. So tax thereon at appropriate rates. What does that give me? That gives me what is referred to here, yeah, this little x, as my income tax liability. In other words, that is the total liability for this individual to UK income tax on their income for this tax year. That's it, end of story, okay? Well, it's not the end of the story, because what's going down here? Well, this says less tax collected at source on income, the difference being income tax payable. What do we mean by this? Well, let's think about it. If I go up and just give you an example, yeah? Let's say employment income. This would be the main example. On employment income, we know that individuals are subject to what's called PAYE. In other words, they have tax and national insurance deducted at source. So each month in the UK where an individual receives their payslip, there will be an amount of tax deducted and an amount of national insurance. Okay? So that tax is in effect a payment in advance each month. So when we come to prepare the income tax computation, you know, as we are doing now hypothetically, we can deduct anything paid at source, and PAYE, i.e. tax on salary, would generally be the name one, and that will be given in the question. Okay? So we get to income tax payable. I mean, after all, if you have a full liability here, for argument's sake, £10,000, if you've paid 4,000 tax at source on your salary, then the difference must be what you have to pay now. Okay? So really, this summarizes our first little computation. Let me get the whole thing in perspective here for you. Hopefully you can still see that depending on what sort of device you're using. Okay, so there you have it. Now, broadly speaking, how many parts? Yeah, well, I would say part number one, populate. Part number two here, deductions, i.e. reliefs. Remember what I said? Qualifying loan interest, more of that later, and indeed the personal allowance. Next part is application of rates. Now, a word of advice here in relation to applying the respective rates. Remember, they're all in the tax tables. Don't need to memorize them. Slow down here, because in my experience of marking questions, marking mock exams, etc., and indeed speaking to students, this is where a lot of the mistakes are made. Not all of them, but a lot of them. It's the application of the percentage rates, even though they're available in the tax tables, to these amounts. So my advice here in part three, slow down, yeah, be careful. Part four is just the credits. That's straightforward. It's just a deduction, okay? So there we have it. I'm going to make this a little bit bigger as we go through. Hopefully it's not too big for you. Okay, so there we have it. That's the income tax com. We'll be talking about that a lot. Okay, now outside of that, income. Let's talk a little bit about different forms of income. We touched on it up top. We're talking about non-savings in the first instance. So it's earned. Yeah, you earn it. Employment, trading, pension, and property. Broadly speaking, we're saying that this type of income is the first income in the first column on the IT computation. Okay? Next one, savings and dividends income. Now, I haven't put any detail here from the study hub because it's pretty straightforward. I have a bank account, I earn interest on it. That's it. Put it in the second column. It's savings income. Same with dividends. There's some detail in the hub that you can look at, but I have shares in a company, private or listed PLC. They pay once a year a dividend to me. Put it in the dividend column. That's it. There's nothing much else to it. Now, there are some tricky little areas in terms of the taxing of these amounts, which is not relevant to this particular part of the mind map because we're just talking broadly about the income. But I would say, or I would draw your attention, to this area in terms of, remember what I said, part 3, application of rates. It's a little bit tricky. Okay, exempt income. Now, exempt income, the examiner very, very likely to include some areas. Let's say that it's a meaty, big, comprehensive income tax computation in section C. Highly likely to include some exempt income. What does that mean? Well, it's basically exempt. It's not taxable. Yeah. So in a section C style question, what would you do if you see it? So let's say that I see, I don't know, an easy one would be national lottery winnings. Yeah. So he includes trading income, maybe a bit of interest income, dividends, and also national lottery winnings. You would simply include national lottery exempt, 0. That's it. You're done. So again, this area needs to be rote learned. There's some more detail, as you can see, in other chapters. But be careful about this area of exempt income because really it's marks for nothing. All we need to do is rote learn the list. Nothing technical to it at all. Okay? Now, in terms of income of married couples and persons in a civil partner, again, I put no detail here. And the reason for it is the main essence within the ACCA study hub is just that. Married couples and persons in the civil partnership are treated separately. They're taxed separately. They're taxed as individuals. Each of them have their own tax affairs. Each of them will have their own income tax computation. Now, you may think to yourself, well, yeah, wouldn't they? Well, I can tell you, going back to, I think it's the early 1970s, I know this is not relevant to your memory, but believe it or not, married couples, the wife's income was taxed as the husband's. Civil partnerships didn't actually exist. This came along in the 1990s. But believe it or not, married couples, the wife didn't exist in her own right in tax in the UK. Her income was lumped in with the husband's. So I guess we're trying to make it clear that in today's modern world with feminism and women's rights and all the rest of it, basically people are simply taxed as individuals. End of story. Okay. Now, next area, again, this is quite straightforward, base of assessment. Broadly speaking, within income tax, most income, nearly all income, is taxed on an actual basis. So you earn it in a year, you're taxed in the year. That's it. End of story. So nothing to that at all. I want to focus in within these videos on what I feel is important, not what's sort of, secondary, if you will. I'll leave you to look at the real detail within the study hub. But as I said elsewhere, we've got bigger fish to fry than thinking about actual or current year. Okay, now we talked about the personal allowance, can you remember? In the income tax computation, and in the second area, as it were. And we know what it is. So what's the basic rule? The basic rule is that it is an amount which a taxpayer does not pay tax on. Specific amount given to each taxpayer each year with the effect of, or intention if you will, of raising the starting point of income tax. So in effect, what HMRC and the UK government are saying is that, well, if someone is a low earner, we don't want them paying, heavy duty tax. Let's make some sort of what you would call free pay amount before you have to pay tax. That's it. Nothing more than that. But I mentioned the little caveat, the reduction. Okay? Now, this reduction is not complicated. It's basically a little formula. It's logical. Yeah? What are we saying? We're saying that if a taxpayer's adjusted net income, definition below in a moment, exceeds 100,000, that's a fair amount of money. The personal allowance is reduced to nil at a rate of £1 for every £2 that net income exceeds 100,000. In other words, the formula, you'll see the formula within the study hub. In effect, what we're saying is, let's just say that we have an ANI, or adjusted net income, of 105,000. This individual is quite happy. They're earning quite a lot of money, in one way or another. Well, here comes the revenue. And they say, well, you've got a very large income. Do you know what we're going to do? For that additional £5,000 over 100,000, we're going to cut it in half. And that 2,500, i.e. 5,000 divided by 2, we're going to take that off the value of the personal allowance. So in effect, what we're saying is you don't deserve to have a personal allowance that says someone who is earning £7,000 a year or £10,000. You don't deserve it because you're earning so much money. So nothing complicated with this at all. But what do we mean by adjusted net income? Because in the comp, we just saw net income, didn't we? Adjusted net income means net income less gross pension contributions and less gross gift aid contributions. Now, excuse me. Right just now, you'll be thinking, well, I don't really understand what a pension is. I don't understand gift aid. For the moment, just take it that there are areas, that an individual taxpayer in the UK can invest into. Pension, for example, that's just saving for a pension. Or perhaps the individual is feeling generous and wants to give to a charity. That's gift aid. So, in essence, this definition of adjusted net income, is or sort of begs the question what an individual could do. And this is maybe a little bit over the top for TX. What they could do and say, oh God, it's likely that I'm going to be over 100,000 in this tax year. Maybe I should make a gross pension contribution, because if I do, I can reduce my ANI to below 100,000 and not lose my PA. Just some simple planning there, but you get my drift. Okay, so that's the reduction. Watch for that trick. Okay, so that concludes part one. I hope you found it helpful. As I say, if any areas within the video you're thinking to yourself, oh, I don't get that, this looks complicated, I could be in trouble with this exam, don't think like that. I mean, well, everyone thinks like that when they come into the first area of computations, in this case IT or income tax. Everything will fall into place. All we need to do is to keep putting one foot in front of the other and practice. Okay? Thanks for listening. Please do join me for the next part. Cheers.